Hey guys, if you ever wondered how you can own multiple properties, keep your tax filings in check, ensure great asset protection, and on top of that have privacy? Well, the answer is probably a Wyoming Holding Limited Liability Company. And in this video, I'm going to show you the benefits of using this strategy for your overall planning. All right, let's get started. Okay, there's a lot of groups out there and individuals that talk about using various LLCs, holding LLCs. And in fact, on this channel, you'll find ample videos on the use of Wyoming Holding LLCs. And in fact, it becomes my foundation for a lot of my planning. But what I'm going to go into is showing you the reasons behind that, how you can benefit from setting up this type of entity in your plan, and why you want to think about setting it up sooner rather than later. All right, let's go over there and talk about this. Okay, so what am I getting at? We're talking about setting up an LLC in Wyoming. All right, we're going to set this company up. Now, as I stated, why would I want to set up a Wyoming Holding LLC? What's going to be its purpose? Well, its purpose for real estate investors is to take their entities where they hold their properties. Let's say I have 3 LLCs that I've set up that owns real estate, and take that interest and have these LLCs owned by this one Wyoming limited liability company. That's why we call it a holding LLC, because its purpose is to hold other limited liability companies. Now, by doing this, I would become the member of this Wyoming LLC. Maybe it's me and my wife. We're both the members, and we're going to be the managers of this LLC. So this one LLC here will own all of our LLCs. And so a question that comes up a lot is, how many real estate LLCs or business LLCs can I place inside of this one Wyoming LLC? The answer is as many as you want. You can create as many LLCs as you want inside of there. Now, what are some of the benefits of adopting this type of plan, and why would you want to do it? Well, number one, it's going to be asset protection. Okay, so what am I getting at here? Why having a Wyoming holding company offers asset protection? You see, part of putting together these types of plans is to ensure that we're protected not only from the real estate that's held inside of the LLCs, from tenants suing us, but I want to protect my businesses from personal creditors. That if I get sued individually, a creditor can't take my assets. And so let's assume that this couple here lives in California. If they didn't have a Wyoming LLC set up and they own these LLCs, these are all California limited liability companies, and they were involved in any type of litigation and they were sued and a judgment's entered against them. Well, a creditor under California law could take a judgment and go right after their LLCs and take their California LLCs from them because they own those LLCs. They're the direct members in that limited liability company. Now, by using a Wyoming LLC, what we're doing is we're creating a buffer there. We're picking a jurisdiction like Wyoming that offers enhanced asset protection. And they do that through the use of what's called a charging order. So that means if someone sues these individuals here, this couple, and they get a judgment against them, Wyoming will not allow that judgment creditor to take their Wyoming LLC. You see, there's no link between these individuals and their California LLCs any longer. That's been severed. They own those California LLCs through their Wyoming LLC. So they can't get to these. That is, a creditor can't get up here. The only remedy is to go against this entity here, and Wyoming does not allow a creditor to take this interest. The only thing a creditor's entitled to is a charging order, which means that they get any income the members distribute to themselves, but nothing else. Now, there is some talk out there when we talk about charging orders and using out-of-state LLCs, people will say, well, if you live in California, a judge in California can issue a charging order against your Wyoming LLC. That's correct. They possibly could. But the point is, even though they issue it, doesn't mean it has any effect, because this is an entity that exists in Wyoming. So in order to give effect to that, you would still have to go to Wyoming and get a court there to recognize it against this entity. So this is why we like to do it. Number one is asset protection. The second reason is privacy. Okay, when you set up the Wyoming LLC as a holding company, the best part about Wyoming, no information is disclosed, right? So what do I mean by that? Well, in California, if I create an entity in California, Washington, Oregon, Tennessee, whatever, your information, if you're the member, you're the manager, is going to be listed on the Secretary of State's website. So think about this. A tenant that's disgruntled can pull your information off the Secretary of State's website, know where you live, how to contact you, show up at your house, harass your spouse. I don't want that to happen. I don't want my tenants knowing where I live. I don't want my customers knowing how to get a hold of me. So by using this blocker entity in Wyoming, we maintain a level of privacy that you just can't obtain without it. So what happens here is that if somebody looks at this entity, this California entity, the way we're structuring this is that everything points down to here to Wyoming. And with that Wyoming LLC, Wyoming's not collecting any information on the members or the managers of the company. They just don't ask for it. So when somebody looks, that is a third party, a disgruntled client, a disgruntled tenant, they're going to see the name of the Wyoming LLC, but they're not going to know who it's associated with. They're not going to know your information. So privacy is really good here. The third reason why you want to be using this type of structure is because it consolidates tax filings, all right? So what do I mean by that? That when you set up several of these limited liability companies, oftentimes what happens is that if there's two members involved, all of these will be set up as partnerships. So you're filing multiple tax returns on an annual basis. It's not uncommon for me to start working with a new real estate investor that's been setting up entities with their CPA. Say they live in Ohio and they have 6 LLCs and they're having to file 6 tax returns every year, 1 tax return per LLC. I look at that and I'll say, hey, you want to reduce 6 down to 1? It's possible. All we have to do is change the owners from you and your spouse to this one entity here, and we'll eliminate tax returns all across the board up on the top. And now you're only filing 1 tax return right here. How do we do that? Well, by making this Wyoming LLC the sole member or owner of your real estate LLCs, these LLCs no longer have to file returns because they turn into what is referred to as a disregarded entity. That is, there's only one owner. So by doing that, you can reduce the costs of your annual tax filings and simplify your overall tax life. So that's why I like to use a holding company. And then the fourth reason why is for lenders. All right? That is to make you look better to lenders so you can get more deals done. So that means you can obtain more financing. Why is that important? Well, obviously the answer is because the more money people are willing to loan me, the more deals I can do. And so when you use a holding LLC, one of the strategies is to treat this one as a partnership for federal tax purposes. So this entity here has to file a tax return. Nothing else does. By setting this one entity up to file a tax return, it will provide you a K-1 because it's going to file a 1065 federal tax return, which is a partnership return. The benefit is where that income hits your 1040. You see, a lot of real estate investors, maybe they don't have a partnership return. They start out, they own real estate in their own name, or they own real estate in entities that don't file tax returns. And all of it shows up on their 1040 Schedule E. That's where real estate is carried. When it comes to filing a Schedule E, if you have that same real estate held in a partnership or passing through a partnership return, it's going to show up in your Schedule E, but it's not going to show up on page 1. It's going to show up on page 2. And that has a dramatic difference in what you qualify for when it comes to borrowing. Now, what am I getting at here? Well, it's real estate income. When it shows up on page 1 of your 1040 Schedule E, a lender who is underwriting a loan with Freddie Fannie, when they look at that income, they're going to discount it by 25%. So if you made $100,000, they only give you credit for 75. Why? Because they're forced to hold back 25% for vacancies. Now, the way you get around that holdback is you take that same income, you run it through a partnership, and you have it hit your return on page 2 as a line item. So it'll just list out the total amount of your income as a line item on page 2 of $100K rather than every single property on page 1. Now you get 100% for that income. So when you go to get that loan, rather than showing only $75,000, you get to show the full $100,000 for qualification purposes. 4 very important reasons why you should have a Wyoming Holding LLC in your structure. If you're a real estate investor, I highly recommend you consider setting this up. All it's going to do for you is give you additional opportunities to provide protection, reduce the number of tax returns that you're filing, provide the anonymity that I talked about, and make you look better to lenders. Hey guys, if you like this video, be sure to hit the like button. And if you're not already a subscriber to my channel, smash that subscribe button so you'll get updated every time I release new content, so you'll stay up on the latest when it comes to tax and asset protection for real estate investors.